Hello, everyone. Welcome to Custody, the new global competitive landscape. I have three custody experts and leaders in the crypto world here with me today. I'm Avi Salzman, a senior writer at Barron's Magazine, and I'll introduce them. This is Sam McInval from Coinbase. This is Alex Kesh. Sorry, let me make sure I have everything. Alex Kesh, the CEO of On-Chain Custodian, and Matt Jennings, the CEO of Kingdom Trust. Very excited to get this started here today. Our readers at Barron's are mostly financial professionals, institutional investors, and when they hear about Bitcoin and crypto, they just think theft, theft, theft. How am I going to lose all these pensioners' money if I go into this crazy field? And obviously, on the other end of that are questions for guys like you, and I'd love to hear how you deal with those kinds of questions and that kind of news flow from customers. So I'd love to hear one at a time, please. Sam, let me know how you answer those questions.
Sure. Thanks, Avi. Fundamentally, custodians, and I think securing any sort of asset, they need to be underwritten based on their track record. So how long have they been securing an asset? To what success have they had towards that end? Coinbase has been securing Bitcoin for over 7 years now on behalf of our tens of millions of retail customers around the world. So we have a long track record of doing this successfully.
Alex?
It's all about the service and the focus that the custodian will have on the assets and the work that he's supposed to deliver. So On-Chain Custodian, for example, is only a custodian. We don't do anything else. So all our attention, financial means, and efforts is on custodizing, doing research and development on the best way of doing custody, and focus, as I would say, is, in our view, the essential part of providing a good service.
Yeah, so Kingdom Trust, the same. We're strictly a custodian, and we've been doing it. We've been a regulated financial institution for about a decade. So we were around before the crypto markets and specializing in alternative assets and unique assets, and really found our way into crypto because we had customers in the investment space that wanted to do Bitcoin originally, now a lot of other things. So yeah, it's all focused around service and security. I think that's what we really try to focus on, is having great service and great security, and being really hyper focused on the service and security around custody and not other aspects.
How do you explain to someone who hasn't invested in this before and is considering investing a lot of money what your services are like? I mean, how do you explain it maybe as compared to, say, a stock or a bond or something they might be more familiar with?
It's really hard to compare crypto to traditional financial assets because there's this really fundamental tenet, which is hard to grasp this difference between the two. And specifically that is that everything in traditional finance is effectively reversible, and nothing in crypto is reversible. And that statement, I think everyone hears it and they're like, I get that. But until you're pushing the button on a multi-million-dollar send on a blockchain and you realize that you might have an O swapped with a 0 and that's going to cost you all of your money, you don't really understand the stress and anxiety that comes with, hey, none of this is actually reversible. So I think making sure folks really understand the gravity and the additional threat vectors that are at play here. And then again, I think pointing to a track record, right? So securely storing crypto for many years, proving that it actually is possible to keep these assets secure and to service clients around the world in a regulated fashion. Those are the sorts of things that people need to see, and over time, as we do more and more in that, they're going to get much more comfortable with it.
What kind of questions do you get, Alex, that where you have to explain to maybe a more traditional investor what you do and why it's important that you have this specific expertise?
Yeah. So in Asia Pacific, there is still a lot of education that is required about the need for custody, and that's what we have been doing with other custodians in our region, is to explain the importance, as you just mentioned, of the private keys, right? You can't really mess up with those. If you do mess up with those, you lose your assets. If you use a crypto exchange that is not properly secure, you may lose your assets. So we've been educating and explaining that having an independent third-party custodian that can hold assets instead of keeping them at the exchange, instead of having them on a USB stick at home, instead of sending private keys via email to operators like I've heard in discussions with family offices, for example. Having good, sound operational and technological environments by specialized custodians is an important component to a successful investment.
Yeah, so we just did actually a Barron's conference a month ago, maybe in Salt Lake, where we talked to the top 400, I think, or so investment advisors in the U.S. So it was actually, I got to ask this exact question a whole lot that week. I will say one of the really cool things out of that conference, when we went into the conference, they did a survey and asked, how many of you have ever recommended crypto or see yourself doing it in the future? And it was somewhere around 5%. We did the education, we did it with Rick Edelman, one of the nation's top financial advisors and a crypto advocate. They did the same survey after it was over, and I believe it was around 80%. So there was a huge shift in the thinking through people just getting educated around, you know, the security, all the things that go into that. But for me, when I try to explain the difference to someone who's from those traditional markets, is the difference is really around, in custody, really is around the private keys. Other than that, it's very much similar and the same, and what they're going to see from us is very similar to what they see from us in the traditional markets that we work in. But what they need to know on the backside is the security around the private key. I mean, the control of the private key is custody, right? In the digital space, where it's different than in the more traditional securities market. So that's really where the difference is. Other than that, it's very much a similar experience.
Are there, you know, people talk about using cold storage for custody. Are there extreme measures you have to take for physical protection of the cold storage that I mean, you don't have to reveal exactly where everything is, but is there something that you realize that you had to physically secure these assets in a way that, obviously, you know, the story of the Winklevoss brothers, you know, tearing up the private key and putting in different safety deposit boxes. Do you have to do that, something like that on a grand scale? Anything you can reveal about that? I'd be interested.
Absolutely. First and foremost, I think it's really important to recognize, especially in light of some of the recent security incidents around the space, offline storage or cold storage is really the only proven method of securing crypto assets long term. Any crypto assets that are kept hot sooner or later tend to be involved in some sort of security incident. So at Coinbase Custody, we only keep our clients' assets offline right now. And you're absolutely right. I mean, we go to incredible lengths to secure these assets, from Mission Impossible styled vaults. We run physics experiments to make sure we're generating enough entropy to have truly random private keys. We have redundancy, so we have to store these keys in many locations around the world. A common saying is we want to make sure no small asteroid can take Coinbase Custody offline, and we really hold ourselves to that standard.
I will add the human component to it. So in all hacks, many hacks, the human factor is important. One, so in the recent one with Binance, for example, they revealed that it was probably through social engineering that it happened. Of course, it was a hot wallet, so it's different. But even in a cold storage environment where keys are effectively kept in different safes, etc., you still have the possibility of your staff doing something wrong, either misplacing a key component of the operational process, or actually committing a crime. So another aspect that we do, and I'm sure my neighbors are doing the same, is screening our employees and ensuring that by security companies to make sure that these person don't have a track record of crime, that's obvious, but also don't have any credit issues with banks, for example, which would tempt them to do something that they shouldn't be doing.
Yeah, it's you know, at Kingdom for us, it's very much it's not a wallet. Like, you know, there's this software component to it that a lot of people refer to as a wallet, but it's an entire security system that involves technology, people, geographic dispersion. There's a ton of elements that go into properly securing these keys, and and that's another thing that I tell a lot of people when I talk to people in the traditional finance world, or people who are funds and things that are considering self-custody, is that you can't do it right part-time. Right? So if you're running a fund, or you're running whatever your main business is, or you're just an investor, just a you know, personal investor, to really do it right for large amounts of crypto, it takes a business. You know, it takes a lot of people, it takes a lot of technology, which takes a lot of money, which, you know, and that's what all of us up here specialize in, and we believe that people should not take that on themselves.
If you're now dealing with competition from major financial players, though, how do you convince them? Someone says, well, I can get this at Fidelity, I already bank at Fidelity. Why would you say, well, you know, we have a crypto specialization where we can do better than Fidelity? I mean, how do you compete in a world where the traditional financial players are now rushing into custody, it seems like?
There's a really broad array of services to provide in crypto custody. I don't think crypto custody, I think a couple years ago it was put private keys in safety deposit boxes and maybe have a little bit of redundancy. Today, it's much more about crossing the line from crypto custody to crypto prime broker. And specifically, I think doing that in crypto native ways. So some of the services that we've been rolling out in response to client demand are staking and soon to be governance. These are really common requests. Most hedge funds, most large investors in this space, they want to actively participate in the crypto economy. They don't want to just lock up their assets and not do anything with them. They want to earn a return, they want to do other things like that. So we're turning those services on. And I think that'll be one of the areas that'll be a little tougher for some of the traditional financial companies to compete. And then I think again, you can always go back to track record. There is a fluency within which the folks up here who have been in this space for a long time are able to talk about what it means to secure these assets and point to some track record of having done that for a long time. Understanding the gravity of I can lose these if I just send them to the wrong address, et cetera. Those are things that I think traditional financial incumbents will just take some time to fully understand.
Yeah, and beyond the technology expertise that we have probably better than they do, is the breadth of custody that we can offer. So when you look at the Fidelity offering, is Bitcoin. That's it. So we started a few months ago, and we have 7 coins, and we plan to, of course, upgrade it very quickly to at least the top 20 crypto on the market in terms of market cap. So that's something that we can do because we have the agility, both in terms of compliance and technology, to deploy those coins way faster than incumbent would be able to. They will always be confronted to compliance with compliance department who tell them, I want to have a justification for every single coin you're going to add onto your custody offering. What we do, but in a more agile way than they will be able to do. So we're actually partnering and talking to many of those custodians to see how we can help in a partnership model to support their customers, because they have customers that will never go directly with us because they trust the brand of a Bank of New York, of State Street, but they still want to be able to service those customers. So I think the future will be a future of collaboration between crypto custodians in a way and traditional custodians, and I think it's important that we work towards that.
What happens if there's a truly catastrophic attack, a 51% attack on a major blockchain? What is your liability there? How do you deal with that? How do you deal with the customer's funds in that case, Matt?
Yeah, so it kind of depends on a lot of factors, I think, in that. But if I'm understanding you right, you're saying a 51% attack on like the blockchain itself. In that circumstance, the custodian would not be the one responsible. In many other circumstances, we would or could be the one responsible. But in the event that the actual blockchain itself, which has never been done, obviously, but in the event that did happen, or it would not be the custodians that would be at fault in that, as long because we would still have our keys secured. We did our job. So where custodians become responsible is if they in some way put your key at risk, or break their policies and procedures, which we have a really large policy and procedure manual that we go through and go by, and we have we're a regulated trust company, so we have auditors that audit that. but in a 51% attack, I think it's something nobody wants to really think about, right? But the custodian would not be responsible in that scenario, in my opinion.
What about during a fork? I mean, if you don't necessarily want to support the forked asset, how do you deal with that? How do you deal with the customer's funds? You know, do they have access to it at all times, I guess?
Yep. Coinbase Custody is a trust company, so ultimately we're holding our clients' assets in trust on their behalf. So the key thing is it's their assets. It's not really ours to decide what to do with. We're just securing it for them. In light of a fork, a lot of common attacks that could be played out right after a fork can be mitigated. So that's why you'll typically see custodians turn off deposits and withdrawals, or at least withdrawals for some amount of time after a fork. It's also difficult to spin up new nodes on a new blockchain and understand what exactly is going to happen as you run those. Can you understand the threat vectors that are now in play? So all that stuff takes some time. But fundamentally, our view is these are our clients' assets. It is our responsibility to make them available to them. Even if we're not going to support some asset after a fork because it doesn't meet one of our policies or just there's not enough interest, we still have an obligation to make sure we get that to our clients. We're a fiduciary to them. So we will work as fast as is safely practical to get those assets to our clients so they can do whatever they need to do with them.
Is the future going to be crypto-focused custodians working with traditional banks that have clients that are more traditional? Is that kind of where I saw Alex had said that? I don't know if either of you agree as well with that, or.
So we've worked with traditional custodians for a long time in other asset classes. So, that's pretty common in a lot of ways. You talked about particularly the Fidelity offering, but in the alternative asset space that we kind of started in, it's very common for the bigger custodians to not custody certain assets. If you're, their offerings are limited. They're for a limited group of customers, and they're typically on a limited group of assets. And I don't see that being any different in the crypto space. I mean, we've already seen it now. There's OneCoin, I think. I haven't studied it a whole lot, but and I'm sure that's to a limited group of people that they would offer those services for. And we've actually done a lot of work where we refer things, back and forth in our other asset classes with some of the bigger custodians. So I don't see this really being a lot different from that. I don't think the bigger custodians are not ever going to want to custody every coin that clients are going to want to hold, and they're not going to want to custody for every client. So I think there's room and space for everyone. And everyone will find their niche within that, as far as our group up here and the big guys. And that's how it'll play out. That's the way I see it.
I actually see that happening even between crypto custodians. You can imagine a custodian who doesn't want to build the technology to cover a specific set of coins because it's too specific, or he doesn't want to focus on that. Working with a sub-custodian in that case, who would do that for him. So. Yeah, I think it's collaboration will be the future of custodians, like it is in the traditional space, where an HSBC is using a Standard Chartered Bank in some countries where they don't have direct custody. Why not imagine? And I think it's not even imagining. I think it will be the future of custody as well for digital assets.
I agree with all that. Maybe a slightly nuanced perspective on that is when you're selling custody, you're ultimately selling trust and you're selling a track record. And at Coinbase, we have the benefit of a brand that is really well recognized and really well trusted around the world by both investors and regulators. Oftentimes, and I think predominantly in the next couple of years, we're going to want to be out front with that brand and the services that we're selling. So while ultimately our goal is to build an open financial system for the world, and we will partner and we will work towards that end, I think we'll try and be out front more often than not, specifically selling Coinbase services.
And are you all working with pensions, endowments, those sorts of investors now, or is it mostly a little more crypto focused at the moment?
It's a great mix for us. We have quite a few direct endowment and pension clients of Coinbase Custody. We also interact a lot with those allocators via our clients. So we see those folks allocating capital to crypto first investment managers, and we custody for a lot of them.
We see a big mix as well, which we do everything from individuals to large institutions, and the institutions we're seeing a good mix of really all sorts of endowments, pensions, just traditional finance guys, you know, a little bit of all of it.
In our case, it's more crypto. So we servicing crypto exchanges, we servicing crypto funds, family offices who have some level of investments in those new assets, high net worth individuals as well. But I wouldn't consider those as truly institutional asset managers or pension funds. I haven't seen that happening yet in Asia Pacific. I'm surprised that it's happening in the US and the UK, but it's a good trend.
Well, there's not a lot of pensions and endowments.
Yes.
So, you know, we have a mix, but obviously it's more we're starting to see more interest from more traditional finance guys, as opposed to a year ago, it was almost all really crypto-centered funds and things like that. So you're starting to hear more of the traditional guys starting to ask the questions, and even some of them creeping in.
If people want to also ask questions, you can line up. I'll ask another question or two, but if you want to line up and ask audience questions, please do at the mics on either side of the aisle. What's one question you get from clients that's maybe surprised you, or shown how people may not understand crypto custody? Is there something you've heard or shows the confusion of the average investor out there?
Well, I know we had one this was kind of a funny instance. We actually had someone call a few weeks ago that wanted to know if they could come to our office and pick up their Bitcoin. So it was an individual, wasn't an institutional person, thank goodness, but they literally thought that there was, you know, the more we talked to them, they thought there was, so there's misconception with people in the market, even people that are actually buying and investing. It kind of floored me to hear that, but it was, it goes all the way from there to very technical questions. We get them all over.
Well, technically, you could give them a Tezos or a ledger with their Bitcoin on it.
You could. They thought, though, they were going to come and actually get
physical
the coin. Yeah.
Would you like to ask a question?
Hey, for Coinbase, I was just wondering how you do both governance and custody while keeping the coins offline.
Yep, great question. The question is, how do you do governance and staking while keeping funds offline? And the specific answer is it's protocol by protocol. So you have to look at each specific protocol that you're going to support, and you can work that in. So the two that we support right now, we support Tezos staking, and we will soon support MakerDAO governance. In both of those cases, you can effectively keep a key in cold storage that is securing the transfer of those funds. And then a lot of forthcoming protocols, what they're doing is they're splitting up and using multiple keys. They'll have one that's typically called the spend key, and that's what's used to move assets around. Then they'll have separate keys for voting and staking. And as you can imagine, this is a much safer world for us to live in, because you can keep that spend key super secure, and then you can keep those voting or staking keys warm, hot, whatever you want to call it, more available, so that you can be signing transactions with them much more frequently. So we're a big proponent of that type of protocol architecture.
Cool, thanks.
Question.
For any of you, how has your engagement been with the SEC? It's a custody panel. The SEC focuses on qualified custodians. Curious how your engagement has gone.
How your what?
I didn't
engagement, communications, correspondence with the SEC.
SEC. If anyone would like to answer.
I didn't hear what he said.
Oh, your engagement with the SEC. What's that been like?
It's been good. We've met with the SEC a few times. We've met with the CFTC. I think they're searching for the right answers. I do. Obviously, it's not happening fast, and near as fast as all of us in this room would probably like to get clear guidance. I've said in panels and things I've been on before, it's just be clear about it. That's what, it's like Pompliano on the podcast I do, and he said, what's the biggest regulation you'd like to see changed or different? And I told him, I said, just make them clear. Mm-hmm. I'm not so much that I care exactly how they make their regulation. It's just make them clear, concise, where everybody knows the rules, right? We all want to know the rules of the game. And I feel like in the meetings we've had with them, they listened to what we had to say. They asked a lot of good questions. And I believe that it's coming. The question is, when is it coming? When are they going to get more clear regulation?
Well, in our case, we are located in Singapore, so our regulator is MAS, and the beauty of that regulator is that they are clear on what is regulated, what is not regulated, when do you have to have a license, when don't you have to have a license. So it's been a pleasure actually to engage with them, because they're first a bunch of very smart people coming from the best universities in the world, and that's generally what happened in Singapore. They hire the best working for the government. So you have really intelligent and interesting discussions with those guys, and they can hear that they want to be proactive and also futuristic in the way they see regulation. They only see regulation as a way to mitigate risk, so they are a risk-based type of regulator. So they're not going to regulate if there is no risk as far as they're concerned. So it's quite comfortable to operate in Singapore.
Coinbase Custody is a New York limited purpose trust company, so we're directly regulated by the New York Department of Financial Services, which is a very crypto-forward regulator. They wrote the BIT license. We engage regularly and proactively with the SEC, and we really enjoy those conversations.
Perfect. Thank you guys very much. Thank you to the audience. I hope you learned something.
Nope.
I think we're...
There was a question there, but
Sorry, I think we're out.
I'm gonna ask the question anyway since I have a big voice. Staking rarely beats the inflation rate of the underlying crypto. And I remember one of you saying that there's an institutional demand for staking. Is it for something other than financial return, or do you feel that they're not sophisticated enough to understand the economic return of staking versus underlying inflation? Hard question.
I'll leave that to you.
That's what you get for trying to walk off on me.
I got part of the question, which was something to do with staking rewards.
Staking often doesn't compensate for the inflation of the underlying crypto. But one of you, I think it was you, said that you have significant demand from institutions for staking. So the only demand that would be significant would be strategic, unless the institutions are not sophisticated enough to understand the full economic return on investment.
Yeah, the
of
quick
staking.
answer there is it's both. I think people want to participate in staking rewards that they can earn. I think people also want to actively secure blockchains and they want to help bootstrap these networks, so they want to be part of helping grow those networks as well. So if you think about something like Tezos, the more bakers that you spin up, that's a healthier network. A lot of early investors want to help. They want to be out there, out front, pushing the network forward. Good question.
Thank you.